Good morning, everyone. Welcome to DealStreetAsia's last webinar for the year, and we're doing this in partnership with Ontra. My name is Joji Philip. I'm the founder and editor-in-chief at DealStreetAsia. Just want to take a minute for a quick, just few housekeeping rules before we begin proper. We are recording this session, and the full transcript and the video will be made available to all our readers and subscribers next week. This will be also available on the DealStreetAsia website. Attendees, you can submit your questions via the Zoom's Q&A function. The questions will be curated and we'll aim to have them answered in the last 5 to 10 minutes of the discussion today. Before we kick on, before we move on to the webinar, our next big event at DealStreetAsia will be our Jakarta Summit. We are bringing it back next year. We couldn't have it this year due to COVID. It'll be virtual next year too. The details are here. So it's on March 8th and 9th. Make sure you don't miss it. So let's move on to our webinar and the topic for the day. We're going to be looking at how virtual deal making all through the pandemic, it's had a transformational change. While physical meetings may stage a comeback, and as the travel bubbles start to emerge, technology and outsourcing some of the key issues related to deals that we think is going to continue and is going to play a much greater role going forward, particularly in addressing the legal and due diligence requirements. And for both PE, VC firms, hedge funds, and I think this will also provide a great opportunity to compete on an equal footing and make a serious play for the numerous startups and growth companies that are in the region looking to raise capital. Today, we plan to look at some of the operational and best practices that help deal makers across Asia tide over the pandemic. I'm joined by a bunch of eminent panelists who are best placed to discuss this. I will just quickly introduce our panelists, maybe just ask them to take a minute or two to introduce themselves. I'm joined by Nakisa Chopling. She's the Managing Director, Head of Legal, Tribon Capital Management. Pratibha Jain, she's the Group General Counsel and Head Corporate Affairs at Everstone Capital, which is among the largest private equity firms in South Asia. Ivan Davis, he's the Managing Director of Quadria Capital. They are a PE firm that is specialized in the healthcare space. They operate across Southeast Asia and India. And finally, John Crandall, Managing Director, APAC Ontra. So I'm just going to ask all of the panelists just to take maybe less than a minute to introduce themselves and their respective firms. Nakisa, you want to go first?
Sure, thank you. Thanks for the introduction. So I'm Nakisa Jobling. I'm Head of Legal and a Managing Director of Tribon Capital Management, which is a investment fund that operates across 3 strategies, being a traditional hedge fund, a long-only fund, and a private equity fund focusing on growth opportunities with a Asia thematic bias. Prior to that, I started out as an M&A and corporate lawyer at Clifford Chance in London, Tokyo, and Hong Kong. And before joining Tribon, I was in a corporate doing their M&A across Asia and the States.
Thanks, Nakisa. Pratibha, you want to go next?
Yes, hi. I am the Group General Counsel and Head of Corporate Affairs at Everstone Group. Everstone Group, again, cuts across various strategies. It's got over $5 billion in management, mainly in Southeast Asia, but we're global. We've got in the group a venture capital fund, a private equity fund, a credit fund that we just launched, a logistic funds, a data center fund that we just launched, and a renewable energy fund. Prior to Everstone Capital, actually, just recently I moved back in-house. I was in private practice, heading the Delhi office for Nishit Desai Associates, which is an Indian law firm. And prior to that, I was head of legal for Goldman Sachs in Mumbai. So I've been on both sides of the table.
Yeah. Thanks, Pratibha. Ewan?
Thanks, Jody, and thanks for the introduction. So good morning, everyone. Pleasure to be here. My name is Ewan Davis. I'm a Managing Director at Quadria Capital. We're a private equity fund, but we specialize in healthcare only, as Joji mentioned. So we manage about $2.5 billion of assets right across the services space, so hospitals, clinic, the full value chain of life science and pharmaceuticals, medical technology and devices, and other areas of healthcare such as telemedicine, pathology labs, so on and so forth. Pleasure to be here. Thanks.
Thanks, Evan. John?
Yeah, good morning, everyone, and thank you for the introduction, Joji. First and foremost, I didn't realize we're the last DealStreetAsia session of the year. I'm a bit honored to close out the year, and particularly on a topic like innovation and disruptive deal making that I think is a good way to look forward into 2022. So I'm the managing director for Asia Pacific at Ontra. Ontra is a Silicon Valley-based legal tech company. We're really a legal tech company built by and for private equity. So our founders were private equity investors, and we focus on legal tech to make private equity and other asset managers their day-to-day lives easier and streamlined. So now we're a global business working with around 500 asset managers globally. Prior to joining Ontra, I was a transactional lawyer, so I call myself a recovering lawyer at this point in my career. I spent about 11 years in private practice, started at Sullivan & Cromwell in New York in the transactional group, and then spent most of my career in private practice in Singapore with Libor Transition as an associate, and then with Dwayne Morris as a partner, focusing on capital markets, particularly IPO fundraising around Southeast Asia, India, and to an extent, broader APAC.
Yeah, thanks, John. To kick off, we just want to sort of ask all the panelists, start off with a bunch of big picture questions. When it comes to innovation, virtual deal making disruption, it's not just the smaller PE firms or the mid-tier PE firms. It's across the board globally, even some of the biggest firms. So Orlando Bravo, the billionaire co-founder for private equity powerhouse Thoma Bravo, in an interview with Bloomberg in the middle of this year, and their firm actually oversees over $80 billion worth of assets. And he was of the view that virtual deal making is here to stay. And I quote him, he said, life is going to get much better in the future than it was before. His firm, which specializes in tech buyouts, had sealed about $20 billion worth of deals as of mid this year without doing a single in-person meeting. Even let me start with you. Do you agree with this view? Do you think we will return to a pre-pandemic normal, or will the new reality of flexible work, less travel, and deal making by Zoom, is that here to stay?
Great question. I think not to hedge my bets, but I think it'll be a hybrid. I certainly agree that we won't go back to how we were working before. I think the last 2 years, certainly within Quadria, has taught us that we can work in very different ways that we would not have chosen before, which certainly have been more efficient in many ways. So I think certainly me, when I look at all the travel we used to do, I believe that some of it is imperative, that you can't get away from it, that nothing beats an in-person meeting, either at the kind of crunch time of the deal on very sensitive, important issues which need to be discussed with the promoters, and that's best done face-to-face in a closed room. But then there's other more kind of business as usual type discussions, which there was a preference to do those in person, but for really no reason other than it was nice to catch up with someone. But with all the travel and planes, taxis, and all that, it's very inefficient. So I think we've kind of gotten past that, and I hope that that stays in the past, so that we can be more productive with our time. But do I think that we will never get on a plane and that we will only do our deals and manage our portfolios, over this interface? Absolutely not, because my view is at the end of the day, it's a people business. And I know we'll talk about this a little bit later, but so long as people are managing business, running business, making decisions, it'll require people-to-people interactions. Technology is a fantastic enabler, but it doesn't replace it. I'll pause there. So a bit of a long-winded answer, Joji.
Just a quick related question to you, Evan. Quadria has offices in Singapore, head office here, offices in India. Does this mean that going forward, deal teams don't have to be based together anymore, considering how you've been working over the last 2 years?
Well, we made a strategic decision a few years ago that kind of bit us on the bum during the pandemic, which was because we focus on healthcare, and it's a finite universe of companies that we get to know and that we track and that we work with. We didn't think it made sense to have boots on the ground in Vietnam and Indonesia, for example. We would hub out of Singapore because it's only a 2-hour flight away. And obviously, COVID happened. We still don't think we will put people on the ground just yet. But what we have been doing, interestingly, which was a change for us, is we've been very busy this year. We've made a number of investments. And in order to get our deals done, we actually sent some of our colleagues for extended periods of time into countries like Vietnam or Indonesia. We're comfortable that we can have people away from HQ for months on end, and we function absolutely fine. And in fact, that was the only way that we got some of our investments and exits done. And I think we'll retain that flexibility going forward.
Thanks. Pratima, let me come to you. When we look at a large firm like Everstone, you listed out all the 5 different the kind of different type of funds that you have. You've continued to be active across multiple geographies in terms of doing new deals, fundraising, and also a bunch of exits. It's been about 18 months into the pandemic. Do you think it's too early to assess the long-term implications of virtual deal making? Because there's an argument that a lot of the deals that we've seen over the last 18 to 24 months, there were deals where you knew the private equity firms or VC firms, they actually had a relationship or knew the management teams pre-COVID.
Very true. I think it is too early to call it. We were just getting into the zone of meeting new promoters, looking at deals, traveling to get that done. And then, you have the fears and the closing of the various countries happening due to the new variant. We actually saw after 18 months, people travel like crazy wherever we could. The good thing about Everstone is we have people on the ground everywhere. We have people in the US, we have people in Singapore, we have 3 offices in India. And that's really helped through COVID. Ultimately, I think private equity is more traditional business than law firms or financial advisors. There is a certain element of meeting and especially for buyout strategy that we have pretty much across all strategies. You need to know who you are doing a deal with. You've got to work with them to grow the business. You've got to also be very intricately involved, to have a successful exit from that portfolio. All of that, which traditionally right now we are synced to do when you meet in person. Having said that, I'm a great believer of technology. I've personally worked remotely almost now for 10 years because when I moved to Delhi, I set up the office for my previous firm. So I was in Delhi, everybody else was in different jurisdictions. And we just invested heavily in technology and it really, really worked. And I've done very big deals in the past where private equity firms have hired you because you're based in a certain jurisdiction where the target is, but ultimately there were no physical meetings. So you had the mindset that you need the lawyers and the law firm on the ground in the jurisdiction where the target is, but nobody realized that actually there was no physical meeting for the whole transactional team. We did everything online. Pretty much, you've got virtual data room for deals now. the lawyers are much more comfortable with technology and doing meetings on virtually. But the private equity teams were meeting the targets. So I think that last bit of that personal interaction to make sure you're comfortable with who you're partnering on the ground for private equity firms is still, I think, open to question, so like even said, this is going to be a hybrid model, at least for a while.
Got it. Interesting. Just adding on to what you said, you spoke about the buyout strategy for Everstone, but Everstone has multiple strategies because you also build companies from scratch, like Burger King in India, Indostar. You have a platform approach where you buy companies, combine them into platforms, and obviously your buyout strategy. And as a firm, it's something that the industry always talks about is how you measure the return on time invested and not just the capital invested. So for all of these strategies combined, what are the changes that you had to make during the pandemic? Do we see any broad things that you can share, especially in terms of legal due diligence?
So thankfully, like I said, I think because your service providers are much more technologically advanced, you're able to use very quickly whatever technologies they have to get deals done. So getting deals done last 18 months was not an issue thanks to technology. And you've got, from doing your due diligence virtually, to doing your meetings virtually, to cloud services that can help manage, significant amount of data, to doing regulatory diligence through AI, even financial diligence and financial modeling is much better from a technology perspective with AI now. So financial modeling, and then just making sure for us, like you rightly said, because we are building companies also, and we have platform technology across various funds, technology really helps when you're sitting remotely in managing those assets. So for the legal team, we are increasingly buying technology which will cut across various funds in terms of fund management, both from an operational perspective and a legal perspective. And that's been really key, especially for the in-house team, to reduce the amount of time you're spending on just managing documents, just managing process. Compliance tools that are available now would have required, a lot more significant members in the team, which is now reduced with these compliance tools.
Very interesting point on legal teams and technology. On that note, Nakisa, let me come to you. You, meaning Taiwan Capital, you are among the Asian hedge funds that have been pouring hundreds of millions into dollars into private investments, and you now are competing with both private equity and venture capital firms. You've been doing tech deals in this part of the world. So as late stage investment is increasingly becoming, we're seeing a lot more hedge funds becoming active in this space. How have firms such as yours evolved to evaluate and execute such deals, especially during the pandemic?
Yeah, it's interesting. I think it's become apparent that moving into private equity can be a very lucrative way to diversify strategies. So there's money to be made, and given the difference in the investment profile, it can really help offset volatility in the public business and diversify income streams. So I'm seeing more and more hedge funds kind of in this market supplementing their public portfolios with the occasional private investments, but without committing to having a separate fund strategy solely dedicated to private equity. Personally, I would say that given the stiff competition in the market, to get access to the best deals and to get a seat at the table, you do need to be a credible PE investor, as opposed to, say, just a hedge fund that's dipping its toes. So part of doing that successfully I think, will be to ensure your internal talent pool diversifies alongside your strategy. Deals these days are fast-paced, and with the absence of in-person meetings, relationships alone can't take you all the way. So I think you need to prove you know what you're doing enough to get the deal done well and efficiently. In some cases, that can obviously be achieved with your existing talent pool, since you do get investment team members who've worked on both public and private before, or often I see in hedge fund teams that people come out of private equity into a hedge fund environment. But in other cases, I think a main way to evolve to get stuck into private equity deals is to strategically plug the talent gap so that the person who's representing you in front of a potential target, even if in front these days is on a Zoom, is credible and represents the firm well. I think that would be the main way that the business needs to evolve in order to kind of participate in the private equity market.
Got it. But hedge funds also are used to, having access to a lot of information, especially in the listed companies that you invest in, and you're used to having this information on a quarterly basis. These companies do inform the exchanges if there are any significant changes. But when you do private deals, especially when it comes to due diligence, you don't have access to as much data as you have for the listed companies. And in the last couple of months, there's also not been, or the last 2 years, we've not been able to travel, meet the management of these companies. So how do you get into these deals, and how do you take these decisions?
I think, again, this process highlights how important it is to have the right talent internally to lead the deal process. In a lot of ways, you can actually get access to a lot more information from a private company than you can a public company, because you're not constrained to what's publicly available. And there's no question of MMPI really, or insider dealing. So we approach it as any other PE house would, which is by entering into confidentiality agreements, which then get you access to information under a promise of secrecy. And then, we go through an appropriate due diligence process with external counsel always involved to guide us through it. This is obviously a completely different process to investing in a public company where you don't have to get lawyers involved every time you invest. But for private equity, you do. And as long as you know what you're doing and you're supported by appropriate legal counsel, I think you can definitely get access to enough information to get comfort. I don't think as part of the due diligence process, access to management is a huge obstacle, because it's kind of set in convention as part of the investment process that you will have that access. And if any company tries to deny you that access, that's a huge red flag. So it's more a matter of legal process than a relationship point to get access to information once you're into the swing of the deal. But the point at which I think the relationship matters is before you've agreed to transact, when you're doing your commercial due diligence. And there, I think COVID has leveled the playing field. Since no one's really traveling for business in the region now. So it can be a bit of a smaller commitment to just hop on a Zoom with someone than it is to set aside the time to meet in person. So I think that facilitates smaller funds getting their foot through the door and getting that first meeting and being able to build a relationship virtually alongside everyone else. I think the true impact that virtual meetings has on the ability to cultivate ties with management I think it's yet to be seen, because often for PE deals, as you alluded to, Jody, the relationships are built, over months and years. So I think at the moment, probably the deal volume you're seeing is, firms kind of executing on relationships that were perhaps started or created pre-pandemic. So we'll see if, deal flow changes over the next year or two, and if, as more and more countries start to open their borders where others don't, if that somehow shifts the playing field in any way. I think watch this space for that.
Yeah. Thanks, Nakisa. John, let me come to you. Thank you for waiting. You recently raised $200 million led by Blackstone Growth and Battery Ventures. And you also rebranded to Ontra. How much of this deal, for example, was done virtually, using our own platform for contracts, NDAs, and DD?
Yeah, absolutely, and no problem waiting there. Yeah, effectively 100% was done virtually, and it was really quite a seamless process using digital data rooms, Zoom meetings, things like that. Like, I don't really think for our deal, and there, I'll get to a bit of a caveat in a second, but I don't think for our deal there's really anything at all in the process that would have required or really benefited from in-person meetings. Doing it all remotely just made it fast and efficient. We didn't have to travel for meetings to execute things. I said there's a caveat coming, and that is that the specific managing director at Blackstone who led the deal was actually someone we had a relationship with already, well prior to raising the Series B from Blackstone. He had been with us through our Series A when he was at Battery Ventures. He left and moved to Blackstone, and at that time we were kind of in the right point of our growth trajectory, and Blackstone was looking for investments in kind of the industry, and it all just clicked and made sense. So I think kind of echoing what Nikisa said and what Pratibha said as well is, those relationships, the commercial relationships are something that is really imperative, it's really critical to the deal making. And it's something that I don't think goes nearly so well with tech. That's an issue, an obstacle that tech, at least today, I don't think really solves and surmounts in the same way that personal relationships in person, meeting somebody on a day-to-day basis really does. But once you have that rapport established, you have that trust, you can build a viable commercial relationship, you can build a business and grow it and scale it together, then tech just makes the rest of the process very streamlined, very quick, and very easy. So yeah, part of your question was how much of the process was on our own systems. So we have three main areas that we do. One is just negotiating high volume sort of contracts for private equity companies. These can be things like NDAs or engagement letters or vendor contracts. That wasn't really relevant here because we were doing a private deal with someone we already knew. We didn't go out and do an auction process or anything like that. We didn't try and find 200 bidders and take the best offer. We did a very private deal. So that wasn't super relevant for us. The second thing we do is manage contractual obligations in fund agreements, like limited partnership agreements, side letters. Again, we're not a fund, that wasn't super relevant. The third thing that we do though is really building like digital precedent data banks of agreements. So if you have a lot of contracts, you need to keep them organized. Our systems do that as well. And that's the type of thing that is really useful for just making diligence quick and efficient. We have, as I mentioned, several hundred customers around the world in the private equity space. We have customer contracts with all of them. As you're doing a deal, one of the obvious points of diligence for an investor is looking at the customer contracts, seeing what the nature of those are, looking at the terms across them. And when you're having to survey hundreds upon hundreds of agreements, that just takes a lot of time, either from your internal team or your external counsel, whoever's actually doing that process. And having that all in a system that's organized, that keeps track of provisions, that can very quickly point you to expiration dates, to which ones have rate escalation clauses, to which ones have insurance maintenance requirements. Having that organized ahead of time, it just makes the thing really efficient. You can just give someone access to the system. They can come right in. They don't have to waste dozens or hundreds of hours organizing that data to then start making an assessment of risk or commercial realities. They can do that from the get-go. So yeah, it was totally 100% virtual.
Got it. But John, from what you said, am I right in assuming that traditionally it is believed that for all deal making, a lot of the legal work is handled by a law firm? But from what you said, does this mean that a lot of this work can be automated and it can be sort of realistically disrupted?
Yeah, it does. I'm not sure I would use the word disrupted per se. I think it makes it more efficient because certainly what we do is, we're not intending to replace law firms in the process. And what we're trying to do is make the resources of law firms go much further and make the resources of in-house counsel go much further as well. If you're looking at sort of an investment, or you're speaking to your in-house counsel, to your external law firm, what they're really good at and why they're expensive resources is risk analysis. Thinking about negotiation, leverage, who has the negotiating position in a deal, thinking about novel risk issues that may not have come up, structuring deals at a high level. Those are the sort of strategic value adds for a transaction. And you don't need your most expensive resources then going and running through to identify, what is the governing law clause across 500 documents, or to personally negotiate 100 NDAs, or if you're mid-sized to large fund, maybe 1,000 NDAs a year, that's not an efficient use of resources really for anybody. So, what we're trying to do is use tech to scale up those resources you have to make it so that they can focus on the parts that they do best and offload this stuff. It's really distracting. Task switching is a huge time sink for anybody really. So getting those things off the plate and getting information in a way that's organized for them so they can access it quickly and really just make decisions, better, faster, and cheaper, frankly, at the end of the day.
Thanks, John. Pratibha, let me come back to you, in terms of deal making, and you already mentioned about all the different areas that Everstone operates in. But a big picture question, has COVID sort of forced both investors and companies to look at M&A slightly more differently, in the sense that to include partnership, alliances, more of joint ventures, look at alternate investments sort of to create intrinsic and long-term value?
Thanks. I think, from our perspective, we were already looking at strategies for buyout. It's very important, the partnerships that you're building on the ground, whether it's hiring the right management teams in a platform deal structure to make sure that your deals actually get the returns, or even a pure buyout where you're partnering with a promoter. You still need to find them the right management team, the right partners to grow. The whole idea of somebody like us coming into a deal, investing into a company, is to then lead it to growth that can then provide good exit to our clients, our investors. So from that perspective, we have seen that trend. I think what COVID's going to do is really accelerate it. That trajectory, I think, if it was going a little slower, I think it's going to be more linear. And simply because, even had mentioned, if you're in a particular jurisdiction, you've got to have people on the ground. If you're not being able to travel, and if anything that this latest variant is telling us, as soon as we all started getting comfortable about travel, here we are again wondering, next month, next week, are we going to be able to do that travel? So from that perspective, I think it is going to accelerate that trend of having, specifically for global funds, having people on the ground that they can rely on and really lean on to provide the growth that they need for these investments.
Yeah, thanks. Nakisa, coming to you, one of the points that you had mentioned earlier in passing was the speed at which deal making is happening now. And hedge funds, especially all through this year, lots of examples on coming in quickly, executing deals, doing deals really fast. So in this case, is due diligence the top challenge to closing deals when deals are being done at this speed?
It's a good question. I think it's important not to cut corners on due diligence despite the pace of transactions, and to find ways of being as thorough as you would be if you had access in person. But I think actually, to a large extent, due diligence processes had become virtual pre-pandemic, with people using things like virtual data rooms, online searches, video conference Q&As, all in the interest of time and efficiency. So I think the bigger challenge currently, in my view, is to get through regulatory processes. Because with the pandemic and lockdowns, a lot of regulatory authorities are backlogged, and there's a slight trend of increasing regulation in an already difficult climate. So regulatory approvals can be a gating item to doing deals, particularly if the deal has a very ambitious timeline. So often the need for regulatory approvals will be uncovered as part of due diligence, but most other due diligence findings can typically be commercially addressed through tweaks in the deal documents and price adjustments, whereas if you uncover a need to go through some kind of regulatory process, that's outside of the party's control and a more difficult obstacle to surmount. So potentially that could, frustrate your opportunity to invest.
Yeah, interesting insights on the regulatory, bringing up the regulatory challenges being one of the potential issues that could slow down deal making. Yuvan, let me come to you. Valuations over the last 2 years have continued to remain high. There's abundance of capital. Capital today is a commodity. So when it comes to private equity, don't you think that the biggest challenge for PE is not really COVID or virtual deal making or even the speed of deals, but it's about maintaining discipline? There's a lot of dry powder, so there's pressure to deploy, pressure to bid on deals. So how do you ensure you stay focused and don't get swayed by some of the developments in the market?
Yeah, it's a good question, and I think, Joji, if we want to stay in business as fund managers, then we have to keep that focus. But there's always pressures, as you mentioned, from deployment or fear of missing out on the next great big thing that everyone's jumping on, and you're getting left behind. But we have a very clear set of investment principles that govern our decision making and the way that we think about deals. Which we always, if we find ourselves straying, then we have to refocus on what we're looking for. So we have very high conviction over certain segments of healthcare, and that's kind of where we're placing our bets. And we've built relationships with the leaders in those categories, and we work with them to try and build conviction over a growth plan, a business plan, and the management team that we can invest behind. And we're very clear at what is a fair and sensible valuation, and we stick. We have to be very disciplined to that. So there have been, for all the deals that we have done this year, and it's been a record year of deployment from a Quadria perspective. There's been an equal number of opportunities that we've walked away from because, in our view, and we're not necessarily the smartest guys in the room. So maybe we missed something, but in our judgment, some of the deals are just becoming too expensive, and that would ultimately impact our returns. It shortchanges our investors, and if we don't do a good job for our investors, then we won't be managing anyone's capital. But particularly in Southeast Asia, Joji, that pressure is there. I think it's, in my view, private equity in Southeast Asia is still nascent. It's an emerging and growing asset class. The companies, the opportunity set, are certainly growing at a terrific rate, sort of 15 to 20% a year. So the market is doubling in size every 5 years. But relative to other markets in the world, it's a smaller opportunity set. So there is that pressure to jump on the next opportunity because it's there and in absence of others. But I think if you get sucked into that trap, that leads to poor decision making, poor investments, and hurts you as a fund manager in the longer term.
Yeah, you said it was a record year for deployment for Quadria, but it's also been a record year for deployment for the private equity industry in general, all of South Asia and even globally. And the dry powder that the industry has only gone up. So if you were to sort of look at the industry as a whole, if you look at the 2020 and 2021 vintage, how do you sort of judge the PE space?
It's an interesting question, and I've seen that data too. But then when I see what's happening on the ground, for everyone in sort of professional services, is order books are full, booked out for months ahead, no capacity until sort of January, February. Trying to get due diligence advisors, at times has been challenging because they've been so booked up. I'm talking about Southeast Asia specifically. Right the way through to warranty and indemnity insurance providers. They don't have enough insurance agents to process the deals, and if your insurance package is too small, they're not interested. So there's a huge amount of activity going on, which kind of belies the numbers that there's all this building up of dry powder. I think the markets have been very, very active, are still very, very active. and that will start to come through. But I digress. And to answer your question, I think the last 2 years has been from an investment perspective, has been fascinating. Clearly, the pandemic is a global tragedy, and you know, it's been harrowing. But talking about, you know, from an investment perspective, as you evaluate companies during this period, they are arguably, well, certainly in the healthcare space, they're going through one of the most challenging times that they will ever go through. Certainly in the current generation or next generation of leaders. So having gone through the trials and tribulations of COVID, you know, you can really identify the winners, the agile businesses, the very strong management teams, and it's a fantastic sort of commercial due diligence test, if you will. So I think a lot of the investments that are being made through this vintage will have gone through, you know, just implicitly, far greater, you know, tests and due diligence than in earlier times, and I think those investments will bear out much stronger. So I actually think, even if there are, you know, increasing amounts of dry powder from what has been deployed, I think you'll see pretty good returns from this period.
Got it. Pratibha, just taking this forward with record dry powder, record deals, can PE become a good candidate to assist in the economic recovery across Southeast Asia and South Asia?
Absolutely. You know, there was a Bain report that mentioned that there's over $2.5 trillion that private equity is sitting on in terms of dry powder. Out of that, about over 800 billion just in buyout strategies. And at the same time, you've got the conundrum of shrinking economies. Both developed and developing economies have shrunk during the COVID period, you know, uncomparable to previous years. So I think, you know, given that the kind of knowledge-based investing that, based on research on the last 18 months, that the private equity industry can do in these economies, you know, if we just start deploying, and we have been, but, you know, you can see the pace increase now that you have 18 months of data on how COVID is impacting economies, you know, what sectors are looking like growth sectors post, you know, at least this first phase of pandemic. You will see private equity play a very important role in recovery in some of these economies. You know, the other sectors spook easily, but I think just seeing historical data of how private equity has been investing, I think going forward, some amount of stability and some amount of insight into how pandemic is working will only grow and increase the deployment that you will see from this industry.
Got it. Thanks, Pratibha. Now, Nakisa, let me come to you. Historically, be it private equity or even hedge funds, you were competing with the public markets. But in South Asia, you know, the public markets have not been, in the past, not been too receptive for both tech companies and loss-making startups. But we are seeing that start to change with markets coming back. And in terms of deal making, do you think both PE and hedge funds will look more at control deals, like buyout deals?
I don't purport to speak for the market as a whole, but I'm personally not necessarily seeing an increasing appetite to do buyout deals at the moment. I'm seeing some of the opposite, in fact, because a lot of the most attractive opportunities in the current market are late-stage growth companies where, you know, founders won't be open to giving away control the way founders of a more mature company would. And also the investment risk profile substantially increases with a buyout deal, as well as the day-to-day oversight involved as an investor. So I think these are difficult elements to get comfort on without being on the ground when the deal is done. I'm therefore not seeing a lot of hedge funds dive straight into buyouts if they dabble in private equity, and find that's been more reserved for the traditional PE houses who have the capital and the track record to take on the burden and the risk of a buyout.
Got it. John, let me come to you. Earlier we discussed about all the changes that the firms had made due to the pandemic. But at the same time, there are a lot of additional issues that several new aspects that the pandemic has brought about. It's like termination of contracts or renegotiation of contracts, a lot of additional clauses protecting investors, new agreements, among others. So how much of these new set of lenses that have been added to deals, how much of this can be addressed by tech?
Yeah, a fair degree. Certainly not all of it, though. What tech, maybe I'll start with what tech can't do. And what it can't do really is sort of address the risk considerations, I think, that go into sort of adapting to the changing trends. So when COVID happens, you want people who have expert judgment and experience to make risk analyses, risk calls, advise on how to identify, react to, and mitigate risk. That you really need human judgment for still. But in order to make those judgments, those people need to be armed with information. They need to be armed with the underlying facts. What do the contracts of the target company look like? What do the provisions actually say? How do we go about pulling in, what could be dozens, if not hundreds or thousands of contracts, categorizing them, cataloging them, tracking them, notifying them, and comparing them ultimately, what they all say to one another. That is something that takes huge amounts of manpower, but tech is really, really good at and can do really, really quickly. Taking, for example, customer contracts or commercial contracts, when COVID really started hitting from an economic standpoint around last March or April, one of the big things that everyone wanted to do was go and identify their force majeure provisions. Is COVID, for my contracts, qualifying as a force majeure, or is it debatable? Is it clear? Is it arguable? How do we go about handling our commercial relationships? Can we terminate them? Can we not? Tech is really good at just finding all of the force majeure provisions, identifying the differences between them, maybe spitting out a report for in-house counsel or deal counsel to look at and read. And from there, they start making the analysis. What is the risk? How do I deal with the risk and mitigate the risk? And it's not just COVID, similar things happen all the time from regulatory perspective due to regulatory changes. Another big example in the last couple of years has been the Libor transition. Everybody, I think 5-10 years ago, didn't pay a whole lot of attention to Libor fallback provisions. Libor was the gold standard of the contracts provisions, but they would have the fallbacks there just in case. Well, now that Libor is being transitioned away from, we've seen large asset managers, particularly people who deal with a lot of derivatives contracts, going through and having to catalog thousands upon thousands of agreements and figure out what their Libor fallbacks say. Again, that's a perfect use case for tech, for machine learning to scan through those agreements, to organize it, and to give reports out to lawyers. That being said, machine learning isn't 100% accurate. I think I don't have an exact number, maybe 97% accurate or 98. Ultimately, that's in some ways still kind of disastrous because getting legal analyses wrong 2% of the time is a really big risk. So, from our perspective, it's important to back up the tech with experienced lawyers who can sort of review it and make sure it's accurate, and really just sort of leverage the tech to make themselves more efficient.
Sorry. So from what you said, does that mean that the business model for a company like you is having a strong lawyer network on top of the tech software or AI or machine learning automation that you provide?
Yeah, absolutely. It absolutely is. We call it human in the loop. Keeping the human element involved for those judgments and for quality control reasons. So we're not replacing human lawyers. I don't think there's any legal tech company, not that I'm aware of, certainly, that are even particularly close to replacing human lawyers yet. Maybe 20 or 50 years down the line, that might change. I don't know. But really, for us, it's about making them more efficient, faster, better, cheaper, as I said.
Got it. Even let me come back to you. You closed your second fund last year at about 600 million, just before the pandemic hit. But one common thing that when we talk to private equity firms that we hear is many of the funds have had delays in closing their latest vehicles. That is one. Exits have also been delayed due to the pandemic. But just wanted to ask you, like when it comes to LPGP dynamics, do you think that part of the industry will always predominantly be a people business?
Thanks, Joji. I mean, I kind of refer back to one of my earlier comments. I mean, so long as PE is investing in businesses that are, led, managed, inspired by people, then it's always a people business. Technology is a fantastic enabler, but it's all about the people that are using it. So I think it will always be predominantly a people business, for the time being. I think some of those issues that you referred to, I think are temporary. I mean, I know whilst it feels like COVID will never go away, at some point it will, and so those challenges will dissipate. They'll be replaced by new ones. But do I think it fundamentally changes anything in the industry and in the longer term? No, I don't. In the near term, will there be nervousness or reticence from LPs and not wanting to kind of try or experiment new strategies or come into emerging markets in the same way that they were maybe thinking before? Yeah, sure. And we're seeing signs of that. Are there businesses slated for exit that will maybe come to market a little bit later because of COVID? Yes, we've seen that happening. But we've also seen the reverse. Some businesses have benefited and have actually been able to accelerate their IPO or exit plans as a consequence. So look, we'll get through it. I don't think it fundamentally disrupts or changes anything in the longer term.
Got it.
And as you're recording this, you can show this back to me in 5 years and point out how wrong I was.
Yeah, yeah, thanks, Evan. But Pratima, just a related question to you. A lot of LPs have said that they've slowed down on their commitments, but LPs have all the data on GP performance, on returns. Why from your years of experience in the industry, why do you think that LPs are not relying so much on tech, on crunching the data using AI when evaluating whether to commit to the firms that they have a relationship with or even with new managers?
Actually, in our case, Joji, we've been able to, we closed our first renewable energy fund. We did the final, in the process of doing final closing, but we've raised significant amount of capital during the pandemic. I think the difference might be, the first time funds versus experienced investment firms like us who had those deep relationships with the investors, with the LPs. And I think, to what Evan said, it will remain, numbers can only take you so far. Ultimately, the LPs, when they're investing in the GPs, when they're doing their investments into projects, will rely significantly on the interpersonal relationships. I don't at least see yet us being able to overcome that mindset. Having said that, I think, what we are doing was unimaginable of, quite recently, till recently, doing all these huge virtual conferences. And yet everybody's taken to it very well. So I believe truly that the funds business, the LPs, are much better placed to invest based on data, based on tools that can help them assess GP performance. But that'll only be for experienced GPs who have a track record to show. I think for first-time GPs, that will actually create more problem solve their issues of being able to make those relationships.
Pratibha, thanks. Just a quick additional question to you. Have you seen an increase in carve-out deals? Are you seeing them becoming more popular?
We I think it's still up in the air. How that whole industry pans out. I think post-pandemic, you will probably see that part of the business take up more than in the past. I think right now people are also being a little more traditional in their approaches. What they have seen work in the past continue to happen.
Got it. John, let me come to you. From what Pratibha had said earlier about maybe the challenge is for some of the newer managers when it comes to raising capital, because LPs will largely go with managers that they're comfortable with or have a relationship with. Do you think tech can sort of bridge this gap, or do you think that the flight to quality will only be increased further if the pandemic continues?
I think that the smaller to mid-size managers have a lot of advantages here, actually, in a lot of ways. I think that tech can really bridge that gap, and sort of proactive and thoughtful adoption and use of tech in particular. I think fundamentally the flight to comfort, or the flight to quality is a flight to comfort at the end of the day. And that's really about trust, building that trust between the LPs and the GPs. I think that's fundamental to the success of any asset manager at the end of the day. You need to be able to ultimately be responsive, be accurate, be insightful in your dealings with investors. I mean, on top of returns, I think returns are a given, but they're not enough by themselves. If you don't have the ability to interact sort of positively, proactively, and sharply with your investors, returns aren't going to be enough. Luckily, I think ESG and tech is really helpful, tech is really helpful here. So ultimately, mid-size and small managers are much more nimble. They don't have legacy, 50 years and thousands of contracts and global organizations they have to overhaul at the end of the day. And actually, I found a really interesting survey I was reading a couple weeks ago from Deloitte, which is around 97% of asset managers. They focus on tech at the portfolio company level in their due diligence and how they can adopt tech and transform tech. And that's a key part of the commercial analysis and the integration of companies post deals. But at the same time, only a little less than 60% of asset managers actually actively look at their own use of tech and how they proactively adopt tech. And I think that 40% of asset managers who aren't doing that, I think they're going to get left behind at the end of the day. Just taking, for example, let's say your LP-GP relationships and your LPAs and your side letters. Ultimately, those are the contracts that govern those relationships. What we're seeing these days with the increase in sort of strategies that asset managers are undertaking and growth in fund sizes and ESG trends is that more investors are asking for side letters. They're longer, they're more complicated, they have more provisions in them, be they key man provisions, investment restrictions, ESG requirements, bespoke reporting requirements, all of this stuff. It's really complicated to manage that. And what we found in speaking with a wide swath of asset managers is that nobody really has a good way of doing it. Everybody just does it with Word files and maybe, if they're really proactive, Excel tables, which is just not scalable to talking about hundreds or sometimes thousands of agreements, each of which can be 20 pages, or for the LPAs, a couple hundred pages. So we're talking literally tens of thousands of pages of agreements and thousands upon thousands of contractual obligations. So being more thoughtful about how you just keep track of all of that can really go a long way. It can help you be faster to answer questions that your investors ask you. It can help you make sure you respond to them on time. You give them notice within the required timings when anything happens. If a key man leaves your company, you can catalog the data quickly and you can sort of respond to that in the way that you need to build that trust and keep that trust.
Got it. We're almost out of time. Just requesting everybody to stay on for an additional 5 minutes. I want to take one audience question. This is this is for Nakisa. So Taiwan has invested in Vietnamese e-wallet company Momo, among other Southeast Asian companies. So what do you make of the legal and regulatory challenges in a market like Vietnam?
Oh, wow, that's quite a question. Thank you for that. What do I make of it? I think, for things like e-wallet businesses, that's an interesting and evolving and dynamic industry in any country, obviously, particularly somewhere like Vietnam. But, the way we do our investments is to look at the market as a whole. So across the region, in the country, we benchmark it against competitors. And we found that Vietnam is definitely investable. And I think opportunities in Vietnam are going to be, booming in the foreseeable. So I think the regulatory and legal framework around kind of growth businesses in Vietnam will move to be more investor friendly. So I think as long as you, do your homework in advance, I think the trajectory of investments in Vietnam is very positive.
Got it. Nakita, just one more question for you. Hedge funds now, if, at least in the last 1 or 2 years, increasingly are focusing on not just macro opportunities, but macro trends. They've been designing, as you said earlier, investment vehicles to sort of deploy capital at scale. We discussed about speed. We are seeing many of the hedge funds actually outsource due diligence to management consultants and other firms. You think that's the way forward, because this sort of turns a fixed cost into a variable cost?
I think opportunities to outsource due diligence will be very well received in the market as a whole. I really do, because as John touched on, it's a very labor-intensive process. So any way of increasing efficiencies, whether that be outsourcing it to a cheaper workforce than say a US law firm, or using AI to kind of shave down the amount of information that you have to wade through, I think would be very, very well received. I personally have to be honest, I haven't heard of legal due diligence being outsourced to, say, a management consultancy, but to the extent that is developing, I think it's a positive development, because you can't move away from the need for human eyes and a human mind to assess due diligence information. But if you can fix costs, that will certainly contribute to deal certainty. So I think that would be really, really well received.
Yeah, I think Tiger outsources all of their work to Bain. I'm not sure if it involves the legal DD part, but I think that's key to them doing deals at the pace that they're almost doing. They've been doing one a day this year. Pratibha, last question. Let me come to you. You've worked on some of the biggest deals in South Asia, multi-billion-dollar deals at Everstone, where you work across multiple geographies, jurisdictions, and in a dynamic industry and across several different sectors. How do you handle it? Do you look at outsourcing a lot of the DD work? And as a legal counsel, how do you even keep pace with or keep up to date with so many markets and so many different trends?
So I do rely heavily on tech, whether it's various technology solutions available for, due diligence. We have Save Risk for ourselves, and most of the law firms we use have it too. You set up those for the deals that you're looking at. You just make sure that you're getting news updates. I love that technology piece. Just attending conferences like these are really helpful in knowing what's happening in the market, and heavily rely on the advisors. So I would expect our legal counsels to be up to date on not only the deal that they're doing for us, but the jurisdiction that they're doing in, and the issues that are related to that jurisdiction. So I think the more I see a firm linked up with technology and using tech to do our deals, the more comfort I get. I'm a big believer that we need to start adapting the right technology solutions. Just relying on people is not going to be enough anymore.
Got it. Before we wrap up, I just want all panelists maybe take 30 seconds. For our audience, we would love to have your predictions for 2022. Ivan, can you go first, please?
Okay, I will give it a go. My predictions for 2022, and I'm wearing my private equity healthcare investment hat on, but I think we're going to continue to see a number of trends that have been emerging continue. So particularly around businesses that focus on preventative healthcare. I think the power of the consumer in Southeast Asia will continue to be a huge tailwind behind consumer health and wellness businesses, both services and products. And you'll also see in healthcare generally the continuing digitalization as that continues to proliferate across traditional healthcare businesses, as well as new healthcare models emerging in the digital space. So those are my sort of top 3 predictions that will be driving deal making next year.
Thanks, Ivan. Who wants to go next? Pratibha?
Sure. I think the adoption of technology as a differentiator for traditional businesses like private equity traditionally has, I think, not adapted to technology as much as I mentioned before, legal services or even the financial services firm. I think we will have to adapt much more. You'll see us adapt much more quickly than before, and a significant reliance on understanding how a combination of deals on teams on the ground and technology is going to help you execute, compared to the traditional getting on the ground, big meetings and getting deals done. So I'm really looking forward to seeing how that also works out in the personal space, for an industry that's known for crazy hours. How do we adopt to a more nimble work-life balance?
Yeah, thank you. John?
Yeah, absolutely. Look, speaking to sort of all of our customers, and we cover a wide range of the asset management industry in APAC. We work with GPs, LPs, single strategy funds, multi-strategy, and kind of across investment areas, healthcare, real estate, infrastructure, traditional PE. I think despite that sort of diversity of customer base, there's definitely a common thread in Asia, and that is simply that it is growing and growing really, really quickly. Almost all of those people are adding team members within their existing strategies, adding new offices. A lot of them are doing new things. You take your traditional hedge funds who are now looking at private equity investments like Nikisa's been talking about. They're all growing, they're all expanding really quickly. I think the data I saw most recently was that the PE industry, so the assets under management in private equity in Asia, is supposed to triple by 2025. And there's no way that the professional services grow that quickly. Your law firms are not going to triple in Asia by 2025, nor your accountancy firms or your other professional advisory firms. So I think the only way to manage that is really becoming more efficient. You have to be constantly looking at how to manage that growth, how to be more efficient in your operations. And at the end of the day, that's really adoption of tech. So I see that really happening for 2022. The only caveat kind of hanging over our head, and not to end it on a bit of a down note, is really just what's happening with, obviously the latest COVID variants, but also some of the emerging macro trends, like, move towards more inflation in the market and China real estate market with Evergrande and things like that. So I think that does put a big question mark in a lot of ways. But despite all of that, I think there's going to be pretty hefty growth in Asia over the next year or two.
Yeah, thanks. And Nakisa, to wrap up.
Thank you. I think the trend that we've seen and that I've spoken about briefly, and John, you just mentioned, is I think we're going to see more and more hedge funds diversifying their strategies and moving towards doing more private equity. I think with markets being volatile through the pandemic, and the pandemic making it difficult to predict just how things are going to go for the immediate and semi-immediate future, and also more longer term, it's anyone who is thinking about diversifying into private equity, I think will accelerate that timeline now. So I've been hearing across the past year, murmurings in the market and amongst people around me where hedge funds are looking at ways to move into private equity. And I think that trend will continue. So my prediction for the next year is that we will have more and more players and more competition in the private equity space.
Yeah. Thanks, Nakisa. Thank you to all our panelists, Pratibha, Evan Davis, John, for this insightful session. We are about 10 minutes past the time. Thank you for all our audience who joined us today. We will, like I said, we will have the transcript and the video out on our site and be emailed to you within the next couple of days. Thank you all. And have a great day ahead. Thank you for joining us.
Thank you.
Thank you, everyone.
Thank you.
Thank you, everyone.